But let's get straight to today's action, shall we, with our first guest, Citi head of U.S. equity strategy, Scott Chronert. Scott, it's great to have you on. We did finish the day higher for all of the major averages. It looks like we did get another record close for the S&P 500. How does this set us up not only for the rest of the week, where we know we're going to have some market-moving catalysts here, particularly with the Fed tomorrow, but looking at your forecast for the year 5,100, we're above that now.
Morgan, you're spot on. 5,100 3 months ago seemed pretty optimistic. Now we're looking through the rearview mirror at it. We've been in print with a bull market or a bull case scenario of 5,700. The question's coming up: how do we get there? We think we need to see a clear line to even stronger earnings for this year than we're projecting, which is 245 for the S&P. We don't think we're quite there yet, so we're mostly short-term of the view that we have to digest this move, but completely recognizing that there's a FOMO thing going on here that, given this move, I think we're attracting a lot of money off the sidelines into U.S. equities.
Interesting. How much do Treasury yields matter here? And I asked that on a day where, yes, we're coming off of the Bank of Japan decision. It seems like it was a little bit of a sell the news event. We see some pressure on Treasury yields here ahead of the Fed decision here, but up until at least recently, we've had some disentangling of those two markets in terms of the trading patterns.
Yeah, I think interest rates are facing off with a new growth driver. The way we're thinking about interest rates, and I think this is relevant ahead of the Fed meeting this week, is in terms of 10-year Treasury yields, we think they're very important to substantiating the valuation around that growth part of the market. So this move up to a 4.3 handle, probably not what we'd like to see. We prefer to see it under 4. However, the broadening effect in the market is being led by more economic sensitive parts of the market. Energy has now come up into the fray, along with financials, industrials not too far behind. We'd argue that shorter cycle, shorter duration part of equities, probably more sensitive to shorter term interest rates, Fed funds and the SOFR analogies to that. So, yeah, I think the market at some point here is expecting that we're getting closer and closer to a Fed pivot, even though consensus is now pushed out to mid-year.
Yeah, I just want to correct myself real quick, because I called the BOJ decision a sell the news event. What I really meant was a buy the news event when you look at bond prices.
All right. Well, and Scott, you expect that we need a 10-year that gets lower, right, in order to get 5,700 on the S&P. But if the 10-year moves lower, isn't that maybe even better for the Russell 2000 than the S&P?
Yeah, well, the Russell 2000 is going to be more economic sensitive. It's just the nature of that index construction. So much like the cyclical part of large cap, you want to see pressure coming off of short-term rates to get to a more normalized curve environment that should benefit a lot of the financing that goes with the activities related to that economic sensitive part of the market. Got that. The 10-year component is a little bit different. And there, yeah, what we'd like to see is pressure coming off of inflation expectations that in turn support a gradual valuation. So on the one hand, I want longer term rates for valuation. On the other hand, I want shorter term rates coming down to get a little bit more comfort that we're looking at a more constructive earnings trajectory for the cyclical parts of the market, including U.S. small cap.
So what I mean there is, if you think the S&P can go up 10 more percent from here to end the year, then I imagine you're thinking that the Russell can go even higher than that percentage-wise.
The S&P is led by still a component of the Mag 7. You got 5 stocks that are over half of the index return this year. Small cap's not going to have that. But the broadening effect, as we mentioned to earlier, with energy kicking in along with financials, even industrials, that does play to small cap. So again, small cap is higher beta from a performance perspective for a reason. It's higher beta fundamentally as well. We need to get to a little bit more conviction that you're on the other side of this Fed hawkish rate regime to really kick small cap into gear. We've been suggesting leg in, but don't go all in just yet.